Okay.
I want to thank everyone for joining us. My name is Connor Wrighton, and I'm the Communications Manager for the Northwest Gas Association. We're really excited to have Grant Forsyth on hand to tell us about the latest economic indicators in the Northwest and what they suggest about the economy going forward. But before we get started, let's go over some basics for how these work. We've set aside some time for questions, and we strongly encourage you to ask them as they come up. Though all of you will be muted throughout the presentation, so please use the text box to type your questions, and I will interject as needed to introduce the questions. I will type in an example below, and I hope that you all can see in the chat portion of your GoToMeeting control panel. If anyone's interested in getting a PDF copy of this presentation, Grant has given us permission to send it along, so please send me an email at creiten@nwga.org, and I will send you a copy before close of business today. The easiest way to do that is probably just to respond to the email that I sent out this morning with the code. As some of you may know, the Northwest Gas Association hosts webinars like this one on the last Thursday of each month. And we will be back on December 15th with Chris McGill of the American Gas Association. Chris will deliver the AGA's outlook for the 2016-17 winter heating season. So please visit our website at nwga.org to sign up for that one. Finally, I would like to introduce the Northwest Gas Association for those of you who may not be familiar with us and what we do. We represent the 6 investor-owned gas utilities operating in the Pacific Northwest, along with the 3 large natural gas transmission lines. Our members are located in Oregon, Washington, Idaho, and British Columbia. And as always, please visit our website at nwga.org for more information, or send me an email at creiten@nwga.org. And without further ado, I'm going to pass things along to Grant, and we'll get started here shortly.
Just one moment here while I get this sorted out.
Looks good.
Okay. There we go. And I just need to make one quick adjustment here. So are we still good?
We are perfect.
Okay. Well, good afternoon, everybody. If for some reason you can't see my slides, please make sure you text Connor. I think given the vaguely shocking election results here in the U.S., it's probably a good time to have an economic review about, what is the situation in the U.S. and Canada and the Pacific Northwest. In particular, what I'm going to do is talk about some macroeconomic indicators here, get into some national and regional employment data, rental and home prices, and then at the end, I'd like to talk a little bit about demographics. I think the U.S. election, there was a lot of time spent talking about email servers and tax returns, but not a lot talking about the big issues facing the developed world, and one of those is demographics. Because as we're going to talk about, there's some research showing that's probably going to have a big impact on growth in the developed world going forward. So let's talk about real GDP growth. What we saw in the first quarter 2016 is really the U.S. and Canada on a year-over-year basis really started to converge. The bad news for the U.S. is what we're seeing here, though, is a gradual decline in GDP growth. And this is going to maybe pose some challenges for the new administration, because really what this shows is GDP growth in North America really isn't really super, right? If we think about forecasts going forward, right, we see here 2016, 2017, 2018. The U.S. forecasts are ones I put together. They're the average of a large number of forecast surveys. The forecast for Canada comes from the Department of Finance in Canada. They do their own survey of forecasters. And really what we can see here is really not spectacular growth as expected over 2017 and 2018. Now, that being said, one of the things that's changed as a result of the election in Canada with the Trudeau administration and now with the incoming Trump administration is really going to be an emphasis on fiscal policy, which we have not seen for a very long time. And so it's possible if that fiscal policy is enacted quickly enough and it's done well, we could maybe see a bit more growth be eked out in the 2017 and 2018 period. But overall, the expectation, at least going into the election, is for continued unspectacular growth. Now, one of the headwinds we keep facing in North America is low productivity growth. And what this chart shows is annualized productivity growth by quarter, right? And it's really pretty weak. Now, there's some excitement right now because for the third quarter in the US, I couldn't find it for Canada, but for the third quarter, annualized productivity growth was really quite strong, 3.1%, better than we've seen it for a very long time. However, if you look at the average over this period shown in the graph, the US is only at 0.6%. Canada is actually at -1%. This is really a big problem for North America. Right? If we can't get productivity growth up, then the reality is we're not going to have very strong GDP growth going forward. I mean, just to remind everybody, long-term economic growth is roughly labor productivity growth plus population growth. And so if we're really going to have more robust GDP growth, we really need to see productivity pick up. And we're going to talk a little bit about the things that might be influencing productivity. When I gave a talk in the spring, one of the things I pointed out, there's maybe some growing evidence that it's really not measurement error, that we probably have some structural problems. And one of those problems, as I'm going to talk about, is demographic. Now, if we focus a little bit more just on industrial production, and this is the output of mines, utilities, and manufacturers, you can see here again some evidence of quite a bit of weakness. Really, to be honest, the manufacturing sector has been in maybe a bit of a recession on its own, and we can see that certainly with the case of the United States. My guess is this weakness in manufacturing, along with the ongoing outflow of manufacturing to other countries, probably influenced the election somewhat, because as you could tell from the election map, we had a lot of Midwest and Southern states really going for Trump, and that reflects to some extent the weakness in that manufacturing part of the U.S. economy. The good news for Canada is we're seeing a little bit of recovery there, so going forward, it'll be interesting to see if the U.S. can pick up a little bit of momentum. Now, I want to spend a little time actually talking about this. This really applies to the United States, and I think it's extremely important because it gives us an insight of how the Federal Reserve's perception of the U.S. economy has changed since 2011. Now, what this graph represents is what's called the central tendency. Okay, so every time there's an FOMC meeting, okay, they talk about what the Fed's central tendency is. And that is really the range in which the Fed thinks long-term GDP is going to grow at. And so that dotted line is really the average of the high of that central tendency range and the low of the central tendency range. And again, it's giving us an idea of the range at where the Fed thinks long-term economic growth is going to be. And what you can see is their impression is the U.S. economy is going to be dramatically slower now in the long run than what they had anticipated just a few years ago in 2011. And you can see that right there. Okay? So right now, the Fed's perception of long-term GDP growth in the United States is really under now 2%. And this has a lot of important implications, especially for Congress, because as we know, they're thinking about some additional fiscal policy, probably debt financed. And for this type of long-term economic growth, it does make it harder to cover a deficit without raising taxes. Okay? So something to look for. I think simply the Fed is recognizing that long-term productivity growth probably won't return to where it was prior to the Great Recession. Okay? Turning towards inflation, still really a pretty benign inflation environment for both Canada and the U.S. That gold line that you see above at 2%, that's the central bank targets in both the U.S. and Canada for overall inflation. Some of the inflation data that's just been released for the U.S. shows maybe a bit of an uptick in inflation, but really still relatively benign. If you look at forecasts, again, the U.S. forecasts come from me. They're an average of a broad range of surveys of forecasters. Canada, again, comes from the Department of Finance in Canada. their survey of forecasters. And as it always is, the out-year forecasts are always around that 2% target rate of both the Canadian and U.S. central banks. That rarely changes. And so the expectation is that the central banks are going to be able to push overall inflation back up to the target level in 2017 and 2018. Again, that just reflects the anchoring of expectations around that target. If you look at core inflation, even in the U.S. core inflation is still below 2%. The Canadian core inflation rate is right around 2%. So really, we're not seeing any tremendous inflation pressures building, but at the same time, with new fiscal policy coming down the road, perhaps we could see a bit more inflation. And that was in some of the comments that Janet Yellen made today in front of Congress, is that one of the things she's going to be looking for in the U.S. is how the new emphasis on fiscal policy might impact inflation. So let me just take a pause real quick and see if there's any questions. Connor, do we have from the audience?
So far, so good. If anybody has any questions, please enter them in the chat box, and we will get to them as they come up.
Okay, so if I was to summarize a bit at this point, what we have is really kind of not great GDP growth with still pretty weak inflation pressures. And so, this still remains a concern of central banks all over the world, and this has been the situation for quite a while now. And so I think what a lot of people are going to be looking for out of both the new administrations in Canada and the U.S. is whether or not their policies can maybe re-energize the economy a bit so that you start to see a little bit more economic growth and maybe a little bit more in the form of inflation pressures. It's also useful now to talk a little bit about interest rates. Now, this is the U.S. real yield curve. This is a yield curve that's now being estimated econometrically by the Federal Reserve Bank of Philadelphia. And so it comes out each month. And so what I've been doing is tracking this. And so what we see is the real yield curve out to 120 months, which is the 10-year Treasury, right, in real terms. So the first gold circle you see there is the 2-year. The next, the 60-month, is the 5-year Treasury. And the last 120 is the 10-year Treasury. And again, this is the real yield to maturity. Now, what's interesting about this is the black line is July 2016, the green is August 2016, September, and then October. If you look carefully, what you can see is even before the election, real interest rates in the United States were starting to rise, and therefore increasing borrowing costs. And I think this is what a lot of people maybe didn't realize. They saw the interest rate jump that occurred in the United States following the election results, but I don't know if people really realized that the interest rates were starting to rise even before those election results were known. Okay? Somewhat modestly, but it does help explain why the dollar has gone through maybe a bit of a modest appreciation since the spring of 2016. Now, what I'm about to show you is my estimate, and I just want to emphasize it's an estimate. So what I did yesterday is I looked at what is the yield to maturity, okay, on the 12, the 24, 60, and 120-month treasuries, okay, so the 1-year, the 2-year, the 5-year, and the 10-year. So I looked at the nominal yield and then adjusted them for the Federal Reserve Banks of Philadelphia's estimated expected inflation rate for those periods, and I got something that looks like this. So the green dots show you, as of yesterday, what the approximate real rates have become following the election. Okay? So what we're seeing really now is maybe we're finally leaving this period of ultra low real rates, especially on the 10-year Treasury. Right now, in real terms, the real Treasury rate at the 10-year level is 0, maybe a little bit positive. If you look at inflation indexed 10-year Treasury bonds, which is supposed to be an estimate also of the real rate, they're actually slightly positive. And so the big change here, I think, is that we're maybe finally moving out of this extraordinarily low real interest rate environment, which, by the way, the utility industry has benefited from substantially because of our heavy capital investments. But I think maybe the signal has finally come that we're, again, leaving that ultra low rate environment, and maybe people should be prepared for that. And again, especially if the bond market is going to react so strongly to new deficit spending. I also want to spend a little bit of time talking about Brent Crude prices, in part because just like interest rates, this is having a significant effect on both the U.S. economy in terms of energy investment, but also on the exchange rate between U.S. and Canada. And so what we see here is the actual Brent price, but we also see some forecasts there. The red dotted line represents the short-term energy forecast the EIA produced for the spring of 2016. Okay? The blue line, which is a little bit hard to see, is their new short-term energy, is the black line is their new short-term energy forecast for this fall. Okay? The blue dotted line is yesterday's settlement prices for futures of crude oil, Brent crude. And really what you can see is the outlook for oil prices is significantly better than what was predicted in the spring. Okay? Both the future markets and the EIA forecast are very similar. And what this has done is really helped stabilize the exchange rate between the U.S. and Canada, and hopefully also help stabilize investment, which has been heavily dependent on the energy sector.
Hey, Grant, we got a couple of questions if you're ready for them.
You bet.
The first one is, why did Janet Yellen say that it will be important to raise rates soon?
Well, I think what she's concerned about is that there's a couple things going on. One, I think she's maybe from her perspective, she's seen enough strength in the U.S. economy that they can probably get away with an interest rate increase without necessarily damaging growth too much, but at the same time, making sure that they, in her words, stay ahead of inflation. But the Fed also has another problem, and that is if for some reason the economy does receive a negative economic shock externally and maybe starts to slip into a recession, under the current level of interest rates, they don't really have a lot of room to maneuver. And so I think it's a combination of things at work, kind of pushing her to raise interest rates.
Great, thank you. And we got one more, which is what role are U.S. oil and gas prices going to play in regard to GDP and inflation rates nationally? And what would an unexpected crash or spike in oil prices do?
Well, they do have a big impact on overall inflation. And so one of the reasons why overall inflation has been so weak is because the collapse of energy prices has a big impact on both the personal consumption expenditure index and the consumer price index. So when you have a big decline in energy prices, that's going to push those inflation measures down, no doubt about it. Just like if you have a big rapid recovery in those energy prices, relatively quickly, those energy prices are going to be wrapped around the inflation rate that you see in the economy. And so, the hope is that you get a modest recovery in energy prices so you don't have a shock to inflation, but at the same time, it's a strong enough recovery to get investment restarted in the energy business, which has become increasingly important both for the U.S. and Canada.
Great, thank you.
You bet. So just real quick, in terms, one of the things I pointed out in a presentation in the spring, and this was based on a Bloomberg analysis, is how highly correlated U.S.-Canadian exchange rate, the U.S. dollar exchange rate is now to oil prices. And in particular, when we saw really the big depreciation of the Canadian dollar versus the U.S. dollar, or if you prefer, the big appreciation of the dollar relative to the Canadian dollar, that was really occurring when we were reaching that bottom point of oil prices inside that green circle. Since oil prices have recovered a bit and stabilized, what I'm about to show you is that we've finally gotten to some exchange rate stability between the U.S. and Canada, and honestly between U.S. and our other major trading partners as well. Okay. And just again to summarize, basically when we look at the EIA forecast and the futures, basically forecasts are higher than where they were in the spring, and again, that's probably going to be overall good news. It'll probably cause some additional inflationary pressures, but nothing too significant probably. But again, it helps stabilize investment in the energy business. So if we look at the monthly foreign exchange rate, okay, the red line is the Canadian US dollar indexed to 2012. So 2012 is 100, because I want to be able to compare that against the trade-weighted exchange rate against the US dollar. And again, what you can see is that rapid depreciation of the Canadian dollar, or again, if you prefer, the appreciation of the dollar, was due to those collapsing oil prices. And finally, when we saw them reach their bottom and begin to rise and stabilize, is when the exchange rate between Canada and the US began to stabilize. And so if you look at futures contracts for the Canadian dollar, what we see is that perception or forecast that oil prices will be relatively higher than before and fairly stable, it's helped to stabilize this exchange rate between US and Canada. The forward rates show something in the $1.34 per Canadian dollar range going forward. I should say, let me reverse that. That's 1.34 Canadian dollars per dollar. And that's right now, doesn't change much all the way through 2017. So again, that's basically, indexing the futures contracts to 2012 basically shows us that the Canadian dollar is going to be fairly stable against the dollar going forward. And that's probably going to be overall a good thing for the time being. So if we focus more regionally now, this is a comparison of U.S. employment growth against U.S. growth in Washington, Idaho, and Oregon combined. So the red line is really the U.S. Pacific Northwest, and the black line is the U.S. as a whole. And what's astonishing about the U.S. Pacific Northwest is how much stronger than we are compared to the U.S. And not only that, even though the U.S. rate has been decelerating slightly over time, the Pacific Northwest continues to be relatively strong, around 3% a year non-farm employment growth, which again is extraordinary. And what we're seeing in the Pacific Northwest, we can really thank a very strong employment market for services. Services have been doing very well, and that's a big contributor to the employment growth that you're seeing here. If we look more down to kind of smaller MSAs in the Pacific Northwest, again, they are doing relatively well. Okay? I mean, if you look at the blue is for the smaller MSAs in Idaho, the green is for Oregon, and the red is for Washington. Really not too bad employment growth. Now, we do have some headwinds coming. Okay? We have a new minimum wage laws in both Oregon and Washington. Idaho did not pass these new minimum wage laws. What these laws effectively do is significantly increase the minimum wage from where it was before, and it's also significantly above the now national minimum wage, which is what Idaho uses. And so one of the things that we might start to see slows employment growth is the new minimum wage laws. The change is so large compared to what we've seen before. It's a bit experimental, but my guess is in the long run, probably some firms will try to do with less labor. And again, that's likely to act maybe as a bit of a drag on employment growth in both Oregon and Washington. But, you know, again, it's experimental, and I'm just sort of theorizing at this point. Okay? But again, if you compare that to the U.S. third quarter to third quarter 2016, again, as a region, the smaller MSAs are doing reasonably well, and that's good news.
Hey, Grant, where do the Portland and Seattle metro areas compare on the employment growth chart?
They have tended to be, for a long time, they tended to be much stronger than these smaller MSAs. And now what we're seeing in probably the last 18 months are some of these MSAs, smaller MSAs, are actually stronger than the Portland and Seattle areas. But that's been a long time in coming, and it's unclear how long they can keep this rather robust employment growth up.
Interesting. Thank you.
Yeah, so what I would basically say about the Pacific Northwest, the U.S. side, is that, again, for a long time, the strong recovery we saw in employment was largely contained to the Seattle, the Seattles, the Portlands, the Boise's. And it really wasn't until maybe, again, 18 to 24 months ago where we started to see these smaller MSAs really start to pick up again. And again, their strong growth is also due to a recovery in the service sector. Generally speaking, you can't grow as strong as you're seeing here without the service sector being a major driver of that growth. Okay, if we look on the Canadian side, again, it's interesting to see how sort of the western side, including the BC side, is also growing much faster than Canada as a whole. And again, just like we saw with the US, there's been kind of a deceleration in Canadian employment growth, just like we've seen on the US side, but the BC part has really performed much better. It's very broad-based growth. There's very few sectors showing much weakness at this point in BC. And so again, thinking about the Pacific Northwest as being both the US and Canada, Washington, Idaho, Oregon, and BC, we're doing extraordinarily well relative to the national measures. Okay? And again, that's good news for us, but I have to say it's a little difficult for me to imagine how much longer we could keep this strong differential up. So I wouldn't necessarily expect this differential, as large as it is, to last forever. But at least for the time being, we're definitely outperforming the national measures on employment, no doubt about it. Again, if we look at metro areas in the BC area, one thing that's pretty clear, and this was also the case in the spring, is that most of that growth that we're seeing in BC is really focused in the major metro areas of Vancouver and Victoria. No doubt about it. It's really kind of, excuse the expression, where the action is. If you look at Kelowna BC, I actually tried to do some research on why Kelowna has been down so much. From what I can tell, and this I found quite interesting, and it would be interesting to hear from some of my Canadian colleagues if this is correct, is that Kelowna was the home base for a lot of workers in the oil sands area. And in fact, there were a lot of private flights from Kelowna up to the oil sands to transport workers back and forth who had established households in Kelowna. Because of the decline in oil prices, a lot of those workers are no longer working in the oil sands. And so you see this strong decline in employment in Kelowna. And hopefully that's temporary. But as far as I could tell, that reflects the special situation that Kelowna has as a home base for a lot of these oil workers. Okay? But again, really a lot of the action is in Vancouver and Victoria. And as we're about to talk about, this is having some interesting impacts on the housing markets in both the US Pacific Northwest and the Canadian Pacific Northwest. Now, before I march on here, do we have any questions about that? All right. So let's talk about home prices. Now, there's really two different indexes here. For the US side, I'm looking at what's happening to existing home prices. This is measured by an index that's calculated by the Federal Housing Finance Agency. And these are for homes that have meet conforming loan standards. That is, homes with mortgages less than $400,000 approximately. Okay. Now, on the Canadian stuff, that's looking at new home prices. So the indexes between the US side and the Canadian side aren't exactly harmonized. But what I want to point out is just, again, how much faster home prices in the western part of the US, in this case, Pacific Northwest, and the Pacific Northwest of Canada, how much faster they're growing compared to the national measures. Okay? And, part of this reflects, again, the unusually strong economy we have, but it also reflects, relatively strong in-migration because of those strong economies. Okay? And so, again, the good news is we're starting to see some pretty good home price appreciation. There is, however, some concern in Canada, in particular in Vancouver and Victoria, that prices are perhaps overinflated at this point. And, it's actually causing a fair amount of political friction in Canada when you look at the housing markets in Vancouver and Toronto about what's happening to home prices and how it's pushing out a lot of more middle-income families from those bigger cities in terms of the ability to afford housing. And it turns out one of the big influences now in both the U.S. Pacific Northwest and the Canadian Pacific Northwest is this influx of foreign money. And I might just recommend, if people have time, they might read a Bloomberg article that showed up on November 14th this week. It's called "World's Biggest Real Estate Frenzy is Coming to a City Near You." And what it points out is because of the high price of real estate in China, a lot of Chinese individuals and institutional investors are looking towards the West Coast in both Canada and the U.S. as a place to put their money. And so what that's maybe doing is contributing to some of these price increases that we're seeing, especially in these major metro markets like Vancouver, again, Seattle, Portland, et cetera. And it's particularly these coastal areas that are subject to this influx of money. And so you not only have individuals buying homes, right, Chinese individuals, you have institutional investors interested in financing larger kind of multifamily products on these coastal areas as well. And so it's something to watch, and certainly in Canada, it's been causing some political friction for quite some time. But one of the underreported issues is what's happening to the price of rents across these major urban areas. And so what I'm showing you here, again, this comes from a Bloomberg article, and it says the cities where rent is rising the fastest, and we have Seattle, Portland, Denver, Cincinnati, and San Francisco, and we have the year-over-year increase in rent growth, okay, from 2013 to 2016 and the forecast for 2017. These are incredibly high numbers, especially when you consider for the consumer price index less shelter. Over the 2013 to 2016 period, the average annual increase in inflation, excluding shelter, was only 0.2%. And so again, this is starting to cause some friction, as a lot of people with working class wages are finding it difficult to find either housing to buy or housing to rent at this rate of appreciation. It's really quite extraordinary, actually, how quickly rents are rising in some of these areas. Now, they didn't report on Vancouver in this story, but I will tell you that the University of British Columbia has a professor named Tom Davidoff, and he actually gave an interview in the summer to CBC about rents in Vancouver, and what he found is rather interesting. If I remember correctly, he was following rents as they came up on Craigslist. So in other words, he was following property prices through the Craigslist listings, and again, he was following apartments. And what he found was that apartments on the lower end, meaning lower quality apartments that maybe more working class people would probably try to obtain, based on his calculations, he thought those rents were going to rise about 20% this year. That's a lot. For higher end apartments, it looked like that rents in Vancouver were going to rise about 8%. Okay? And so one of the interesting, or I should say social welfare things we need to worry about is what's happening to the rents paid on apartments that working class people would typically try to live in. And the evidence from Vancouver suggests is that they're actually rising faster than the higher end apartments. And so again, this is, I think, been somewhat underreported. There's a lot of focus on the housing market, but again, what we're seeing is a very hot rental market where it has to be that a lot of people are getting priced out. Now, we're coming to the end here, mercifully. The last thing I want to talk about here is some new research that's coming out about the impacts of aging. And the most recent study is an NBER, National Bureau of Economic Research working paper, and it's called The Effect of Population Aging on Economic Growth, the Labor Force, and Productivity. And so one of the common features of the developed world is a rapidly aging population. And in particular, Okay? What their research shows, and what they did is they looked at the U.S. and they looked at those states that are ahead of the curve in terms of an aging population, meaning they're the most aged states in the U.S. And what they found is that if you look at those states, as the share of population 60 or over increases, you start to notice a significant decline in productivity growth and a decline in employment participation. And what that does is that channels into, from their findings, lower growth in per capita GDP. Now, this has, I think, some really important implications for the Pacific Northwest, because the Pacific Northwest is made up of these very dynamic urban areas and really big rural areas. And one of the things that's happening in the U.S., and certainly in the U.S. Pacific Northwest, is a lot of these rural areas are starting to age very rapidly. And what this research suggests is that over the next maybe 10 to 20 years, we should begin to see the difference, the standard of living difference between urban areas and rural areas really become much, much wider. Now, there was also a study that was released this year by German researchers, and they actually looked across countries, 134 different countries, and they find essentially the same thing. As the share of population 60 and above becomes larger and larger, you tend to see growth depressed. And so I point this out because one of the points of friction in this most recent U.S. election was this friction between big, prosperous, relatively young urban areas and more older, less prosperous rural areas. And my guess is this tension is likely to increase as these rural areas continue to age. And again, their economic growth continues to potentially deteriorate relative to these urban areas. And for the utility business, I think this has important implications because a lot of utilities serve both simultaneously urban areas and rural areas. And I think increasingly the rural areas are going to look much, much weaker in terms of business operations. And it's just something to think about. And the last thing I guess I want to leave you with, this does explain why we're having a decline in productivity growth in the developed world. It just simply reflects, on average, an aging population. And that's something that cannot be easily reversed with monetary policy or fiscal policy. And so with that, I'll go ahead and open it to any questions people have.
Sure, thank you. So again, if anybody has any questions, please type them into the box. We will give you a minute or two here to type those out. In the meantime, I just want to thank you again, Grant, for doing this, and mention that Grant is one of the crowd favorites at the annual energy conference, and we hope we'll be back on June 7th and 8th of this year. So I hope that everybody is putting that on their calendar, and so we are already looking forward to that as well.
Yeah, I would be curious, since I guess I'll take the speaker's prerogative here, if any of my colleagues from Canada are on the line still, kind of what their take is from the Canadian perspective about what a Trump presidency means for the Canadian economy.
And before we lose folks, one more thing is, as we do every month, we have recorded this and we'll be putting it up on the YouTube page. And so if you ask for that link as well, we can provide that. Another reminder that you can email me back at my email address that I sent the link from this morning to get a copy of this slide deck. I am not seeing any questions coming in. I don't want to cut anybody off while they type, so we'll give it another 15 or 20 seconds. Otherwise, again, thank you, Grant, for doing this.
My pleasure. And if anybody has any questions about this, they can also contact me directly if they chose.
We actually did get one question here, and that is, are anticipated Fed changes in the new President-elect Trump administration likely to be a stimulus and or negative for future energy infrastructure development, particularly pipelines?
Okay, can you ask that question again for me?
Yeah. Are anticipated Fed changes and the new President-elect Trump administration likely to be a stimulus and or negative for future energy infrastructure development, particularly pipelines?
Well, let me ask you. Let me respond this way. There's two issues that Trump is worried about. If we're talking about the Fed, meaning the Federal Reserve, my hope is he doesn't mess around with the Fed too much, the Federal Reserve. My hope is he does not try to fire Janet Yellen or any of that, because that's kind of pointless. So my hope is he takes more of a hands-off approach with the Fed, like other administrations. Now, on the other side of it, in terms of federal spending and federal regulation, my guess is that in terms of the pipeline activity, you're going to have a much easier time convincing the Trump administration to permit pipeline activities than you were going to have with the Obama administration. I mean, I think the Trump administration has pretty clearly signaled that they would like to have a more liberal approach to energy policy, and that includes, I think, pipelines. I mean, I think from what I can read, Mr. Trump and his advisors have a much more favorable view of the Keystone Pipeline, certainly than the Obama administration did. And I would have to think that would also apply to oil pipelines, natural gas pipelines, as well as liquefaction facilities.
Great, and we actually do have one more question as well, and that is President-elect Trump has promised significant infrastructure spending. How will that affect the rural-urban divide that we were discussing?
Well, that's a good question. I mean, it certainly would help both, actually, because if you look at rural areas and you look at urban areas, both have a lot of infrastructure that needs to be replaced. And so if nothing else, it would certainly, I think, overall benefit rural areas. Again, if you look at a lot of the infrastructure in some of the rural areas, it's really in very bad shape. So again, I think across the country, it would be beneficial. The problem that we're going to get into a little bit on this is where Congress stands. I mean, everybody right now is talking about what President-elect Trump wants to do, and seem to be forgetting that Congress does in fact have quite a bit of say in how money gets spent. And so the uncertainty to me is, how accommodating will Congress be with the Trump administration, especially since there's really underlying this Republican takeover, there's a lot of personal tension and animosity underlining some of this. So it's not completely clear to me that Congress will accommodate everything he wants to do. That's kind of the uncertainty.
Do you have an opinion on what I-732 carbon tax impact might have been on the Washington state economy had it passed?
Yeah, that's a good question. Well, one of the obvious things it would have done was probably reduce the regressivity of the tax system in Washington state. And so one thing it may have done is maybe given a bit of a boost to lower income people that have a higher average tax rate in Washington under the current tax system. Unfortunately, it may have also perhaps slowed business investment in some ways. And so my guess is, when I think about the net effect of, a less regressive tax system, but also maybe less business investment because of a change in the distribution of taxes, I'm not sure it would have made a big impact one way or the other in aggregate. What's interesting about that, and I'll just throw this out, Governor Inslee was never a big fan of that carbon tax for a couple of reasons. One, I think he was opposed to it because he wants a stronger price response, and he thinks he can get that with a cap and trade plan. Also, the tax neutral part of it, was maybe a bit problematic because for those of you who follow politics in Washington, we need about $3 billion to finance K through 12 to get us out of hot water with the Supreme Court here in the state. And the cap and trade would not be tax neutral. And I think the thinking was you could use some of those revenues from cap and trade and direct it towards K through 12, which wouldn't have been possible with a tax neutral carbon tax. And so my question is if the voters in Washington have soundly defeated a carbon tax, what does that mean about a cap and trade plan? Would they also be not favorable towards that either, because that probably wouldn't be tax neutral? Interesting to think about a little bit. To me, I think maybe it signals that the state is not really ready for a big carbon tax or a big cap and trade plan. I mean, it just doesn't seem like the public has been educated enough, and as a result, they tend to be shy about accepting these either one of these types of carbon controls.
Great. Thank you, Grant. That seems to be all of the questions. So again, appreciate you taking the time to do it. And we will be getting the slideshow and the recordings out to folks here in the next couple of minutes.
Thank you very much. Everybody have a good day.